Good afternoon and welcome back everyone to a very special webinar session. My name is Tony Zhang. I'm the Chief Strategist here at OptionsPlay. And today we're going to be talking about how to get paid to buy your favorite stocks utilizing options. Now, this session is really suited for everyone here that is an investor in stocks or ETFs. And specifically, what I want to show you is how you can utilize options to acquire those stocks that you want to purchase at a discount and get paid to buy the stocks that you want to acquire for your long-term investments. And specifically, the strategy on how to do so, and more importantly, what tools you have available at StockCharts.com to both help you identify the right stocks to buy, as well as what options to sell in order to acquire those stocks at a discount and get paid to purchase the stocks that you want to buy. So let's go ahead and get started. Now, before we do, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the specific securities that I'll be using as example purposes during today's session. And my goal here today is fairly simple. It's to show you a simple strategy that you can use to generate consistent income while acquiring equities at a discount. This applies to both stocks and ETF, as long as they're optionable and you can buy at least 100 shares of. This is a strategy that you can use to deploy in order to acquire those stocks at a discount. So what I'm going to talk through are two separate items here. Number one are just the simple rules to identify stocks to sell puts on, with clear rules as to when to exit and which options specifically to sell. And then management. How do you manage these trades with requiring no more than once a week being able to take a look at your positions and knowing what to do with your short put positions. But overall, from my perspective, this is by far the number one most underutilized income strategy by investors. It is overlooked by most traders, even though it is used by most institutional investors, hedge funds, financial advisors, and some retail traders. But it is a strategy that I think is most commonly overlooked by equity investors as a strategy that out of the gate looks like it's a strategy that has really poor risk to reward until you really understand it, and then you realize that this is a strategy that you might be missing from your portfolio that is going to generate a substantial amount of income. I think most investors, when they first learn as to how much income they could potentially generate from this strategy, they're actually surprised by how much income they are potentially missing out by utilizing this very simple strategy. I'm going to walk you through the strategy, make sure you understand it before we have to jump into some examples. So who is this session for? This is really a session that's for anyone who has a long-term portfolio in equities, whether that's stocks or ETFs. This is something that you might want to utilize. Now, a lot of times when we're doing these sessions here at OptionsPlay, we're focusing on options trading strategies, whether you're buying calls and puts, whether you are trading debit spreads or credit spreads, or trading something more complicated like iron condors. Those are speculative strategies that are generally useful for the portion of your trading, a portion of your portfolio that's allocated for more speculative nature trades, more active trades. But today what we're going to do is we're going to focus on the other portion of your portfolio, traditionally where you actually keep the majority of your wealth, which is your long-term investments. And, in this portion of your portfolio, usually we don't think about options for that portion of your portfolio. Or if you do think about options for that portfolio, you're usually thinking about simple strategies like cover calls, which is a very popular strategy to generate additional income for the stocks and ETFs that you own. However, in order to acquire those stocks or ETFs in that long-term portfolio, this is the part that most investors overlook. And that's what I want to walk you through and show you just how much income you may be missing out in your portfolio just to acquire the stocks that you would have done anyway, but you didn't get paid in order to do so because you didn't utilize an option strategy to enter those long-term investments. But what I want to show you today is how to purchase those securities for your portfolio while generating upwards of about 5% yield in a single month. Not 5% a year, 5% in a single month. That's how much yield you could be generating off of this one specific strategy just to acquire the stocks that you are going to acquire anyway. It requires a few simple rules to generate a consistent income stream, and that's what we're going to go over during today's session. So let's go ahead and start taking a look at this specific strategy. It's a simple strategy. It's a strategy that I'm going to help walk you through and help make sure you understand before we go through some examples and then show you some real opportunities in the market that you can deploy right now using the strategy and the tools that you have access to at StockCharts.com to be able to implement what we're showing you today. So the strategy that we're going to go over during today's session is a short put. It's a simple strategy, and it's a strategy that on the surface may not look particularly appealing until you recognize the true comparison between selling a put versus buying a stock, and why selling a put gives you a better outcome versus outright buying the stock itself. So let's kind of walk through the strategy. The first step is that what you're doing is you're selling a put option on a stock or ETF that you want to acquire. And that's the key word, is that you only want to sell short puts on stocks that you want to acquire. You don't want to just sell puts on something that has high income for the income, because when you're selling a put option, you're selling it with the intent or the obligation to buy that stock. So it should be a stock that you want to own. By selling that put, what you're going to receive is what we call premium, or what we refer to as income, as yield on the cash that you're setting aside to purchase the securities. So when you sell a put option, you have to have the cash to buy those securities. And in this particular case, because a put option represents 100 shares of stock, whenever you sell a put option, you have to have the cash to buy 100 shares of that specific stock. So from that perspective, it is useful, but it may not be particularly useful if, let's say, there's a stock that you want to acquire, but you only want to buy 20 shares or 30 shares or 50 shares. This is only for the stocks in your portfolio where you want to buy at least 100 shares of. And I'll show you how you can scan specifically for lower price stocks if, let's say, you have a smaller portfolio. And then lastly, by selling that put, when you collect the income, it creates the obligation to buy the stock or ETF at a specific price. Now, that last part throws off some people when they first learn about selling put options. What does it mean to have the obligation to buy the stock at a specific price? Well, you're doing something today to purchase those stocks that creates the exact same obligation to buy those stocks or ETFs at a specific price. And that's either a market order or a limit order. Those are orders that obligate you to buy a certain number of shares at a specific price. And if the stock reaches that price, those orders will be filled. And in order to execute, in order to place those limit orders or a market order, you need to have the cash ready to go before you can place that order. So in many instances, selling a put option is really very similar to buying a stock using a limit order, because the mechanics of selling a put is almost identical to placing a limit order, with the exception of the fact that you have to trade in 100 share increments versus a limit order. You can do it at any share increments. And with put options, you do have to use an existing strike price, versus a limit order. You can put in any strike price, but the obligations that you're taking on when you place those orders are identical to each other. The difference between a limit order and a short put is that one pays you income, the other one doesn't. And I think the best way to really understand this and compare it is to use a real example and show it to you side by side, so that you can see the specific outcomes and which one might be better suited for you. Okay, so let's use this example. I'm going to use LI, which is a Chinese electric vehicle stock. And let's say, for example, the stock is currently trading at $27.35. And I have a goal of buying 100 shares of this stock at $26. And let's say I have a price target on as $45 on this particular stock. So what that means is that if I were to buy, and what we're going to do is we're going to compare two different scenarios. We're going to compare buying the stock with a limit order. So that's what you traditionally do as an equity investor. And what we're going to do is we're going to compare that to buying a stock with a short put. And we're going to look at the different outcomes and show you the difference between those two outcomes. So as an equity investor, if you were to place a limit order, you'd simply, buy the stock at a specific price. And if that order gets filled, your total risk on the trade is going to be $26 per share multiplied by 100 shares, which is $2,600. And your potential reward, if the stock rallies to that $45 target price, is $19 a share, or roughly $1,900 for the 100 shares. Very straightforward math that I think any equity investor would understand. Now let's take a look at buying a stock using a short put. So instead of placing a limit order to buy the stock at a specific price, what you would do is you would sell a put option at the price that you were looking to buy the stock at. In this particular case, 26 bucks. And at the time that I was putting these slides together, when selling one contract of the 30-day option for LI at the $26 strike price, when the stock was trading at $27.35, the put options were trading at $1.15 per share, which is $115 per contract. So what that means is that when I sell that put option, I immediately collect $115 in income. And what that does is two things. It reduces the amount of risk that I'm taking on the trade if the short put gets put to me, meaning I end up owning the stock because I'm collecting $115 worth of income as part of the transaction. But it also reduces the amount of capital, the amount of cash that's required in order to purchase 100 shares of the stock because of the $115 of income that I'm collecting when I sell that put option. So if I were to sell the put option, immediately upon selling that put option, my risk on the total trade is immediately reduced from $2,600 a share to $2,485. It's $2,600 minus the $115 that I collect in terms of income for this short put. And what that does is it also at the same time skews my upside potential because it effectively is lowering the cost basis of my trade if the trade gets executed. And that means that my potential reward goes from $1,900 up to $2,015. So just immediately by selling the put, what I'm doing is I have lower risk compared to buying the stock. I have a better risk reward compared to buying the stock, and it requires less cash in order to execute the trade than if I were to buy the stock using a limit order. So right off the bat, just the second you sell the short put, you're immediately putting yourself in this equity trade in a better position by selling the put option versus placing a limit order. Now, I want to be fully transparent because what I'm doing here is I'm comparing it to side by side as if I'm comparing apples to apples. There are a couple of things that are slightly different about a limit order versus a short put, and it's important to understand if this is your first time utilizing this strategy. Because a limit order gets filled virtually instantaneously as soon as the stock reaches the price of your limit order. So as long as there are 100 shares available, your limit order will get filled as soon as the stock reaches $26. With a short put, that's not the case. Meaning, if you were to sell the short put today, and let's say tomorrow the stock is below $26, a limit order in that particular case would have been filled. A short put doesn't necessarily get filled until the expiration date of the short put. So if you sold a 30-day put, you could be waiting roughly 30 days in order for that short put to be filled, meaning if the stock is below $26 at expiration, that's when the short put will be put to you and you will collect the full $115 in profits to offset the cost of buying that stock. So the two are similar to each other, but they're not necessarily identical. It's important to understand those differences before you deploy this specific strategy. Okay, so what I want to do is take a look at what I wanted to do is actually a bit of a thought experiment before we kind of go any further, because it's going to be important for you to understand mechanically, if you found a stock that you like, just like LI, how do you go about thinking which put options to sell. Because if you've ever used any tools for options, let me just pull up, let's say, any stock. Let's look at Apple for a second. If you ever look at an options chain, let's look at options here, you see that there are hundreds, if not sometimes thousands of strike prices that are available for a specific symbol. And that's just for a single expiration date. Look at how many different expiration dates you can choose for Apple. Let's say I go out to the May expiration, and you can see there are strike prices that go from 100 all the way up to $320. That's a lot of choices that you have, a lot of different expiration dates, a lot of different strike prices. So this is the part that a lot of traders find overwhelming, right? When you think about, okay, I want to buy Apple stock. Well, what put option should I choose? What expiration should I choose? What strike price should I choose? It can be very overwhelming. So what I want to first do before we move any further is just to kind of put into your mindset the right frame of mind to go about thinking, how do I pick the right strike price? Okay, so let's do a little bit of a thought experiment here. Here's the stock in question here, LI, Lee Auto, and just to kind of call out some important levels here. This was a stock that has recently call it a bit of a bottoming formation that has formed, that it broke out above that 26.5 resistance level, traded all the way up to 33, came all the way back to 26.5, and now perhaps we are looking for a bit of a bounce, right? We're pulled back to prior support. We're looking at this as a potential entry. So what I want to do is I want to do a little bit of a thought experiment, and I'm going to make it a little bit easy for you, right? Because let's not complicate this too much. We've done a lot of back testing on these types of strategies, meaning we've simulated this particular trade on all S&P 500 stocks going back about 25 years. So that's thousands of millions of trades that we've looked at in terms of helping select what is the optimal expiration date and what is the optimal strike price. And we've simulated this across thousands of combinations to try to get a good sense for which strike selection, which expiration selection gives you the best expected outcome over the long run. So I'll just kind of make it really easy right off the bat, right? When it comes to selling options, when you're selling short puts, if you're selling covered calls, if you're selling credit spreads, iron condors, straddles, anything where you're selling an option and receiving a credit for, generally speaking, we want to go out about 30 to 45 days in terms of an expiration date as a starting point. And the reason that we're choosing 30 days when we're selling put options is because of what I said before. Your put option doesn't get put to you until as you get either close to expiration or at expiration. So when you're selling a put option on a stock that you want to acquire, you want to try to acquire those stocks relatively quickly, which is why we use the shorter end of the curve when it comes to selling put options. So the optimal expiration date when you're selling put options is using 30 days out. So if you're ever looking at an options chain, you can always just quickly go to the 30-day option, which in this particular case is the May 2nd weekly options. As you can see, that has a 31 next to it. That means that expiration date of March 2nd is 31 days from expiration. So that would be where you'd want to start in terms of your expiration date. Now, here's where I want to kind of go through this thought experiment. So the stock's currently trading at 27.35. We noted that the stock kind of has some prior support at 26.5. So I have a few different choices here. I have the 26 strike as a strike price that you can choose. I have the 25 strike as a choice that you can choose, and 24 strike that you can choose. And think of that as levels that you could potentially place a limit order at. You can buy the stock at, you can place a limit order at 26, 25, and 24. And what I have are some information here for each strike price. The 26 will collect $1.15, the 25s will collect 70 cents, and the 24s will collect 50 cents. And I also have the yield information, meaning how much yield are you going to collect in just 30 days? This is not how much yield are you going to collect in 1 year. This is how much yield you're going to collect in 30 days. So think about it. Where else do you see a 4.5% yield in a month? Most of the places, maybe a high yield savings account, you get 4.5% a year. Here you're getting 4.5% per month. I'm curious, if you had to choose a strike price to sell to acquire this particular stock, which strike price would you choose? The 26, the 25, or 24? And I also have the deltas underneath that. And the delta, what delta tells you is the probability of the stock being below this strike price at expiration. So the 35 delta is referring to a 35% chance the stock will be below 26. The 25 delta means there's a 25% chance it'll be below 25, and 24 has a 20 delta, meaning a 20% chance that the stock will be below 24. I tend to find that a lot of people will answer the 26 because obviously the highest yield, right? Why not go for the highest yield? I see a lot of people answering 25s because they always think that something in the middle is best, right? Kind of something, a balanced approach is best. And then I always see a lot of people getting the 24s because, it has a high probability of success. The 24s has an 80% probability that you're going to collect the 50 cents versus the 26 have a 65% chance you're going to collect the $1.15. So this is where, again, like I said, we've done a lot of back testing and it's very black and white. There's no gray area on this. It's very clear as far as what what is the best performing strategy in the long run. And for short puts, it's going to be strategies where you're going to collect roughly about 35 deltas. 35 deltas meaning you're choosing a strike price that has about a 35% chance that the stock is going to be below that strike price at expiration. So roughly 65% of the short puts that you sell will basically expire worthless. You'll keep the $1.15, earn the 4.5% yield, and you can do it all over again. And you keep doing it, but the 35% of the time that you do it, you'll end up owning the stock with effectively a 4.5% discount on that stock purchase. Okay. So like I said, it's important that you understand how you want to think about this. And generally speaking, when you're selling short puts, you want to select strike prices that are relatively close to the current price. That, number one, gives you maximum probability of owning the stock, and it maximizes the income that you receive on that stock. So let's talk a little bit about time decay, because not everyone knows what time decay is. And if you don't, that's totally okay. But for those of you that do, I get a lot of questions from people saying, why use a 30-day option? Why not use, a weekly option, right? You can theoretically collect more income if you were to sell 4 1-week options, meaning doing 1-week options 4 weeks in a row, than to sell one option that expires 30 days out. And theoretically, you're absolutely correct. Theoretically, that is true. However, the problem with that line of thinking is that, one, it's theoretical, meaning if you were to trade 1-week options 4 times in a row, number one, you're paying transaction costs 4 times versus 1 time. And that in itself usually is enough to overcome any benefits that you can get from selling 4 weekly options than you can get selling 1 monthly option, because theoretically selling 4 weekly options will collect more income than selling 1 monthly option. But the added transaction costs largely will negate a lot of that benefit, and many times can actually put you in a detriment. Number two, if you were to sell a 1-week option, and let's say you're anticipating that you would do it 4 times over a month, but just in that first week, the stock drops and you have the stock put to you, maybe you've only collected 1% of the stock's value, and now you've basically purchased the stock, but now you've purchased it with only a 1% discount. Yes, if you theoretically did, or maybe 1.5% discount, because you're thinking to yourself, oh, if I just did this 4 weeks in a row, I'd get a 6% discount as opposed to 4.5% discount. Let me do that. But then, your plans could be spoiled because that first week you could have your stock be put to you, and now you own the stock with only a 1.5% discount. So for those reasons, when you're selling put options for acquiring the stock, you generally want to go at least 30 days out, sometimes even as far as 45 days out. And that's going to maximize your income and maximize the discount level that you're going to be able to purchase that stock at. Okay, so let's talk a little bit about what happens once you sell the put, because there's really two things that can happen, and that's really what makes this particular strategy fairly simple. Not only is the strategy simple, it's simple because the management of it is relatively simple. Because once you sell the put, there's really only one of two things that can happen, and either one of those two outcomes are fairly decent outcomes, right? Number one, the first outcome is that the stock is above the strike price at expiration. If that's the case, what that means is that put options that you've sold have expired worthless, and they're gone, right? And that means you keep the $1.15 or roughly 4.5% of the stock's value. So 4.5% is of the cash that you've set aside to purchase the stock. So you've set aside roughly $2,500 to purchase 100 shares of that stock. The put option expires worthless. That buying power is released. You have the cash back, but you have $115 to keep as a result of it. That's 4.5% of the cash that you've put aside. So not a bad outcome to get a 4%. It's 4.5% yield on your cash. And you can choose what you want to do afterwards, right? Do you want to sell another put option on the same stock and maybe generate another 4.5% over the next 30 days because you still want to acquire the stock? You haven't bought the stock, you still want it. So you sell another put option, maybe collect another $100, $115. And now instead of owning the stock at a 4.5% discount, maybe if on the second month the stock gets acquired, you would now own it at about a 9% discount. So you were a little bit patient. Instead of waiting 1 month, you waited 2 months, but now you own it at a 9% discount. That's one potential outcome that could happen if the stock is above their strike price at expiration. Now, the second scenario is the stock's below their strike price at expiration. If that happens to you, then we call that the puts are assigned, meaning you now own 100 shares of the stock at $26 minus the $1.15. So your effective cost basis of owning that stock is $24.85. So now you own the stock with a 4.5% discount. Instead of buying at 26, you're buying at 24.85. So you're getting a pretty substantial discount on that stock purchase. And like I said, once you actually start looking at this type of strategy, you're going to find quite a few stocks that are generating 3, 4, 5, 6, 7, 8, 7% discount in a single month by using this strategy versus, placing a limit order. Think about it. What if you can get a 3, 4% discount on every stock purchase that you make? And 3 to 4% is on the low end. Many times, like I said, six to seven trades out of 10 will expire worthless, which means that in the majority of the time you are generating, double this amount. Let's say you're generating on average 4%, per 30 days. A lot of times on a stock acquisition, you're looking at about an 8 to 12% discount on the stock purchase because it takes you 2 to 3 cycles before the stock is put to you. And now you own the stock at a much, much larger discount factor than just the 4.5% that you might be collecting in that first month. But effectively, this is a strategy that doesn't really require management. The only thing that changes is if between the time you sell the stock, between the time you sell the put and the expiration date of that put, if some news comes out and changes your view on that stock, meaning you were bullish on the stock, you wanted to buy the stock, and some product announcement comes out or some news comes out or the earnings comes out or something comes out that changes your view and you're saying to yourself, I no longer want to own that stock. That's really the only time that you would do something prior to expiration. Otherwise, it's the type of strategy that you can basically enter and not have to really look at it much until the stock expires. And at the time it expires, one of these two things can happen. And either one of those two outcomes are fairly decent outcomes. Either you've kept the cash and you have a 4.5% yield, or now you own the stock that you want to purchase at a bigger discount than you would have purchased if you place a limit order. Okay, so let's just quickly about some of the challenges, right? At this point, hopefully you have a basic understanding of the strategy, how it works, the mechanics of it. I'm going to go through a lot more examples to make it more clear because, sometimes a single example, if this is your first time, isn't quite enough. I'm going to go through a lot more examples to make sure you're clear on the specific strategy. But I think the main challenges that people have with this is, number one, selecting the right stocks. right? What stocks should you sell puts on? It's hard to. This is a hard question to ask, but this is a question that only you can answer, because ultimately I can't tell you what stocks you should buy for your long-term portfolio. Each of you have different risk tolerances, investment objectives, and just generally different ways of looking at the market. So this is more of a self-selecting opportunity as far as what stocks that you want to sell puts on. But what I'm going to do is I'm going to show you kind of a high value list, if you will, that I use to screen for stocks that I could potentially buy using this specific strategy, and I'll show you why. Second thing is managing short puts if the stock rises quickly and the maximum gain is generated. Meaning, let's say you sell a put option and the stock just takes off, right? What that means is that the put option that you've sold, let's say you sold that LI put option for $1.15, and let's say the stock instantly after you sell it rallies up to 28, 29 bucks after you sold that put. What happens is that the put option you sold for $1.15 is now worth 10 cents, 15 cents, nearly worthless. That is one of the scenarios where maybe you want to take action early because you've made 80, 90% of the potential that you have on the trade already. There's still plenty of time left to go. There really isn't much advantage to continuing to hold that through expiration. You're better off just taking profits and either choosing to recenter your strike prices, meaning chase the stock higher and try to place a limit order or sell a put option at a higher price, or just say, you know what, I missed the move. Let me find some new stocks to sell puts on. For me, I'm in the latter camp, right? If I miss a move, I only like to take trades where I feel the timing is optimal. If the stock rallies after I enter and the timing is just not optimal anymore, I usually am not a big person to chase. That's my personal opinion, but that's a personal choice as to what you want to do in that particular case. But I do advocate that you take profits early and either recenter the trade, meaning chase it and sell a new put at a higher strike price, or simply just move on to the next trade. And the latter, moving on to the next trade, is my preference. And then lastly, determining what to do with a stock that drops substantially. This is a question that I get a lot. What happens if you sell a put and the stock drops substantially? And I always tell investors, what do you do if you bought a stock and the stock drops substantially? It's the same question, right? You're selling a put because you want to buy the stock. And the reason that I'm telling you to sell a put is because if you sell a put option, you have less risk than if you were to buy the stock using limit order. I'm always going to take the strategy that has less risk than the strategy that has more risk, right? Like, why should I place a limit order and risk $2,600 when I can sell a put option and risk $2,485? So, if the stock were to drop and I had sold the put option, I'm going to have less of a loss than if I were to buy that stock using a limit order. So number one, you're already better off by selling that put option rather than using a limit order. And in the LI example, you have a 4.5% cushion. So if the stock were to drop 10% after you sold the put option, instead of losing 10% on your stock, you're only losing roughly 6% on the stock because you've got a 4.5% cushion. So that's why, number one, I will always sell the put option versus buying the stock. The second point of that question is, if you were to buy a stock or if you were to sell a put option and the stock drops substantially, chances are something has materially changed with that stock. Maybe some news have come out, something has affected the stock where it's down 10, 15, 20, maybe more. And at that point, the question is not really what do you do with the strategy? The question is, should you still remain invested in this particular stock? Meaning, has something fundamentally changed about the stock that should change your views as to whether or not you should still be bullish, right? A good example of that is, let's use Tesla, for example, right? Let's say you're bullish on Tesla, but the stock just keeps dropping. At some point, you should reevaluate kind of your investment and decide whether or not this is an investment you want to continue on. So this is something that I think is important that you learn and understand and build as part of your process. Okay. So why do I tell you all of this, right? I tell you all of this because, number one, I truly believe this is by far the number one most underutilized option strategy by investors. If you can get a 4.5% discount on your stock purchase, why not use it? It's going to reduce your risk. It's going to improve your risk to reward. It's going to reduce the amount of cash that's required to buy that stock. There's really not a good reason not to use this particular strategy. However, with that in mind, it takes a lot of work to find the right stock, find the right strike price, and do all the work to figure out, is this the right trade for me? Not to mention, there's just other things that if you've never traded options, you have to look out for, like if there's earnings coming up, how much, what the volatility of the option is. There's just a lot of things that you have to learn. So what we did is we built a tool that's directly integrated into StockCharts.com that automates every single step of what I showed you during today's session. And that's what I want to spend a few minutes on showing you. Is if you go to your StockCharts.com platform, at the very top of your screen, you will see a section called the OptionsPlay Strategy Center highlighted in green right here. And you can access it either by clicking on the OptionsPlay Strategy Center at the top of your dashboard, or you can go to your charts and tools and you will see the OptionsPlay Strategy Center right here in your tool, in your dropdown. And what this tool is designed to do is, number one, help you identify stocks that you might want to sell puts on, and help you identify exactly which puts to sell. It automates everything for you in real time. So what you're going to do is you're going to see in the strategy center, there are a few things that you can select. You can select the technical scan, meaning what stocks that you want, the list of stocks that you want to take a look at, the strategy and the time frame, and as well as how much you're willing to risk. Okay, so let's show you this. The list that I really like to start off with when I'm thinking about selling put options, meaning stocks that I want to buy, is in the bullish countertrend list. Countertrend means that you're trading against the trend, right? So these are kind of pretty bearish stocks that have a potential to turn around. So let's just I'll show you just a chart of this, for example. Let's take the first one, like NetApp, right? This is a stock that has fallen pretty substantially here. And for a lot of customers looking at this chart, they'll say, what are you doing? This stock is clearly bearish. Why are you looking at this from a bullish perspective? Well, that's really kind of where, if you really think about it, we all know this old adage of buy low, sell high, right? And it makes common sense. Well, how do you make money in the markets? You got to buy low, sell high. How do you buy low? You got to buy low when stocks look terrible, when no one else wants to buy it. That's the only way to buy low. And that's what the bullish countertrend signals are meant to try to identify, are stocks that are so overbought that potentially this is a good buying opportunity. Notice this particular stock obviously gap lower from 120 all the way down to the 90s, continued to make lower lows, but as you can see, momentum no longer made lower lows. So you got some positive divergence. You're showing that sellers are getting exhausted. This could be the potential turning point where the stock starts to rally. For those of you that are not comfortable with kind of trading counter trend, this goes against every fiber of your body that tells you, no, stay away from this stock. You should be shorting this stock. But if you really think about the true opportunities, how do you actually buy low? How do you buy stocks, early in a trend? Is you have to go against the trend. And that's what this stock does. That's what this scan does, is it finds stocks that are going against the trend, that are potentially exhausted, that have a high bounce potential, right? So that's what the bullish counter trend list. All of the stocks in this particular list, we'll take a look at maybe Nike, one that probably many of you are familiar with. This is a stock that's really kind of taken a bit of a beating here over the last few weeks. And the question is, has it gotten up to a point where it could bounce from here? And the other thing I want to talk about is the fact that a lot of people look at this and they'll say, this is really high risk to be buying a stock that's looking that has a chart that looks like this. And I couldn't disagree with that more, because stocks that look like this actually have the least amount of risk. What do I mean by that? If I were to buy Nike at 64.60, which is where it's trading at right now, what's my upside potential? I'd say at the very least, probably somewhere in the high 70s would be my potential upside if I am correct that this is a bottom. And then look at how much risk am I really taking, right? If this stock makes a new low, I'd say, you know what? I got my timing wrong. It's time for me to move on to the next trade, right? How far does the stock need to move before it makes a new low? It probably only has to move about maybe $3, possibly $4 before I'd say, hey, it's making new lows. I clearly didn't get the timing on this right. Let me get out. So look at that risk to reward ratio. How much can you potentially make versus how much can you potentially lose? When you take trades like this, your risk to reward ratio is skewed in your favor as much as possible. Now, I get it. Not everyone's comfortable with this. I'll show you a different scan in a second that will be more comfortable for those of you that like trading with momentum and trading with the trend. But my best trades come from this specific scan. Stocks that are so oversold that no one else wants to touch. That's why I'm buying. If you think about institutional investors and what they're looking for stocks like this that no one else wants to touch, that perhaps they're onto something and they want to buy it when everyone else is selling. And that's the secret to this bullish counter trend list. So what we've done here is we've taken this list of stocks, and this list is updated every single day. So you get fresh new ideas every single day. And what you're going to do is you're going to merge it with a specific strategy. In this particular case, we're going to use short puts. And what this does is once you select short puts, our tool automatically selects the correct time frame and risk profile for you based on what I just taught you. So it automatically selects 30-day aggressive. So the only thing you have to do is select the scan, the strategy that you're looking to do, in this particular case, short puts, and now the tool will do the rest of the work for you. You could adjust the max risk. Generally speaking, you might want to adjust this a little higher because you do need to account for the fact that you need to buy 100 shares of the stock. So let's say I'm moving this to $25,000 just for argument's sake for 1 second. And what this does is it basically takes every single stock in that bullish counter trend list. It goes out and it finds the 30-day aggressive short put for that specific stock, and now ranks it for me so that I don't have to go through this entire list one by one, looking at the options trades, finding the 30-day option, calculating the yield. This does all of that work for me. And as you can see, it ranks it based on the yield that I'm collecting and gives me a top to bottom rank. And many of you use, StockCharts scooter ranking. You're very familiar with kind of ranking here. But instead of ranking the stock, we're ranking the options trade for each stock and tells you which stocks generates the most yield and lets you work the way down. So what you can do is you can basically look at this particular list and say, okay, are there any names that I recognize that I would like to, that are on my buy list, or like stocks that I like that I would potentially buy? And those are the ones that you probably will spend a little bit more time on. So Block is the one that I've recently been looking at here, previously called Square. And as you can see, the stock's currently trading at 54.84. If I were to sell the May 2nd $52 strike price, I'm going to collect $2.70. On a $50 stock, $55 stock, collecting $2.70 is the equivalent of 5.5% that I'm going to gain in 31 days. That's a lot of yield, right? If I were able to replicate that throughout the year, that's going to, come out to roughly 87% yield annualized on that cash secured put. And it gives me all of the other information that I generally need. What expiration date, what strike price, how much premium, how far does the stock need to move in order to reach the actual strike price, meaning the stock has to decline 5% in order for it to reach that strike price. The IV rank here is 70%, and there's earnings coming up on May 1st. So these are all, and this expires on May 2nd, but earnings are on May 1st, right? So these are things that I need to be aware of, but this is kind of why we built this tool, is so that you don't have to do any manual work. You just select the scan, the strategy, how much you're willing to risk, and we do everything in real time and gives you everything that you need in order to potentially place that trade. So if I'm interested in owning Square, or Block rather, this is the May 2nd $52 put is what I would sell, and how much premium I can collect and how much yield I can collect is all at my fingertips. So I don't have to go anywhere else in order to make that trading decision. The only thing that I might do at this point is maybe analyze the stock chart, right? And make sure that I agree with the timing of this particular chart. And what I really like about this particular trade is that this stock has really been hammered here recently here. It's starting to make lower lows in terms of price, but did not make a lower low in terms of momentum. So you got that positive divergence that you typically look for that tells you sellers are getting exhausted, and that is the potential buy signal here. And now you've got this potential to move higher from here and gives you that opportunity to earn a 5% yield on your cash, or own the stock with the 5% discount. So those are kind of my best opportunities, in my opinion, when I'm looking for stocks of this particular nature. I'll go through a few more examples here. Let's look at Delta Airlines. The airlines have really taken a hit here. They've lowered their guidance here for 2025. This was a $68 stock that's now trading at 41. Same thing, lower lows in price, higher low in momentum, showing that positive divergence, showing us that sellers are clearly starting to get a bit exhausted here and has that high bounce opportunity. Great candidate potentially for selling put options here. So selling the May 2nd $40 put option will collect 4.86% over 31 days, which annualizes out to 74%. And they do have earnings coming up on April 9th. So that is one thing that I do want to pay attention to is, that's coming up in a week's time. Maybe that's not something that I want to do because maybe earnings could come out and the stock could move substantially lower again. The guidance is really what moved that stock last time. So maybe that's one I want to avoid. But now I have all the information that I need to try to make that decision as to whether Delta is a trade that I want to make. Let's look at one that doesn't have earnings like MongoDB, right? Let's look at MongoDB for a second. You're going to see a lot of stocks with this current setup, right? This was a $380 stock in December, trading at 176. This is a stock that effectively halved in price in about 4 months' time. So, and again, same thing, lower lows in price, no longer making lows in momentum, which is a good candidate potentially for a bounce. And, it tells you exactly what expiration date, what strike price to sell, so that if you were to go out into your brokerage firm, you can sell the May 2nd 170 calls, and you're going to collect $8 in income, which is about just shy of 5% yield that you're going to collect. And there's no earnings coming up on this particular stock between now and that expiration date. So you don't have to worry about that or look out for that between now and that expiration date. And it does all of the work for you so that you just simply have to look for, you can go down the list and simply look at which stocks that you like, if there are any, and you simply have all of the information at your fingertips to potentially acquire that stock. What I'll do is also show you another scan for those of you that are not as comfortable kind of quote unquote catching a falling knife. I'm going to show you the bullish trend following scan. So the trend following scans are obviously pretty straightforward here, but we'll do the same thing. Short puts, 30 days out. Let's look at kind of that list. Okay, let's look at Intel, for example, right? Popular stock, everyone's familiar with it. Intel, as you can see, recently kind of broke out here above 22, came back to retest this as resistance, and we're looking for its potential move higher here. Not the best setup for a trend following stock, but you can clearly see, what we're trying to do is we're trying to see stocks that have broken out, have pulled back here, and now have that opportunity to get long. And again, even though we're following the trend, what we're trying to do is we're trying to maximize our risk to reward ratio. Meaning if I bought the stock at 22, which is where it's trading at now, what's my upside? It would say my upside's at least 27, 28, right? But at the same time, how far does the stock need to move below support where I'd say, you know what, my timing's not right? And I'd say no more than a couple of bucks, right? Maybe $2 at most. So I'm looking at about, $5, $6 to the upside, $2 to the downside. So you're talking about a 3-to-1 risk to reward ratio on that. So even when we're following the trend, I'm still trying to help you maximize the timing on this and maximize the risk to reward ratio on this specific trade. So let's take a look at another one. Let's look at PDD. Some of these Chinese stocks right now are really trading at rock bottom valuations. And, this is a good example of a stock that started to trend higher here, pulled back, started to trend higher, pulled back. And what we're looking for is a potential continuation of that move higher here. So trend following stocks are, but like I said, it's following the trend as opposed to going counter trend. Counter trend is basically trying to pick these bottoms and hoping to get one of these big moves here to the upside. Trend following, you're basically saying, okay, I'm only going to trade in the direction once this trend has been established, but I do want to be a little bit what's the right word, conscientious of timing. So I'm going to be waiting for that pullback, and then I want to pull the trigger, right? That's what we're doing with these trend following ideas, is we were trying to basically identify a trend, but at the same time, wait for a bit of a pullback in that trend in order to enter, because that's going to maximize our risk reward. But regardless of which one you're more comfortable with, I tend to like the more counter trend ideas. That's when you can tend to get the big moves. But even if you're just more comfortable with the trend following ones, either one of these scans, the trend following scans or the counter trend scans, will allow you to scan for 30-day aggressive short puts with the risk profile that you have. Click on update and you'll be able to have access to exactly which one. So for example, for Intel, this is telling you to sell the May 2nd $21 strike. That's going to collect $1.05. That's over 5% of Intel's value that you're going to collect in income in just 30 days. So even if that stock doesn't end up being put to you, you're now earning over 5% yield on the cash that you're putting aside in order to buy that particular stock. And one thing I'll just note, for those of you that have smaller accounts, right, what you can do is you can just sort it based on the last price of the stock, right? So let's say you can only afford to buy stocks that are under, let's say, $30, 100 shares of. Well, sorted by the stock price, and now you don't have as many choices, but you basically find the one that has the highest yield within that. And so for example, XPeng, Intel, Tal Education, these are all over 5%. There's one that's actually yielding 10.5%. Solar Edge. Let's take a look at that real quick. This is obviously a much more volatile stock. Maybe in the early stages of a bottoming formation here. It's kind of cleared that $15 price. It was trading below 15 for a long time. Now it's kind of trading above 15. And now we're looking for that potential breakout here to the upside. So, obviously, clearly a more volatile stock, but you can generate a lot more yield in the more volatile stocks. But this kind of gets everything that you need at your fingertips within just a couple of seconds, right? You select the scan, you select the strategy, and you can basically in real time get a good sense for where you can sell cash secured puts, and where you're going to not only sell cash secured puts, but where you're going to get the most yield, where can you get the biggest discount, and how can you get paid to buy your favorite stocks. Okay. So with that, to get access to this tool, it is just $40 a month. It's an add-on that you can add on to OptionsPlay to your StockCharts account. And you can add this add-on using that QR code on your screen. It's just $40 a month. And my goal is to show you how you can utilize this tool and capture enough income in just your first trade to offset at least 2 to 3 months of your subscription, if not substantially more than that, on just your first trade. In almost every single example I showed you here today, you're collecting anywhere from $100 to $200 worth of income per 100 shares, which is the minimum that you can sell a put option for. And that can, offset, at least 2 to 3 months worth of the subscription in just your first trade. So by signing up for that add-on, you're going to get the seamless integration with StockCharts. It's going to give you access to the strategy center. You can actually have all of the ideas in our strategy center populated in your chart list. It's one of my favorite tools at StockCharts is your chart list. When you have the add-on at StockCharts.com, you're going to see the top 6 are going to be read-only chart lists. So for example, I can look at all the stocks that are in that bullish counter-trend list and see, which ones I really like the setup for, right? So I can quickly just take a look at some charts and say, okay, which ones do I really like the setup for? And maybe those are the ones that I'll take a look at. And there's actually a lot of interesting setups here at the moment, where I'm showing you the stock is making a lower low, but momentum is no longer making a lower low. You have both RSI and MACD no longer making lower low. That gives me a higher probability of a big move here to the upside. So, I see a lot of setups that are very similar to that right now. Usually we don't see this many, but given the current market conditions, we have a lot of setups like this. And for those of you that are more aggressive, you could look at buying call options. You could like using debit spreads. The strategy center is not limited to short puts. I'm only showing you the short puts, but you can use this for all other types of strategies as well. So, for example, if you're looking at that list of bullish counter trend ideas and you're thinking to yourself, I want to get more aggressive. Let me go and buy call options. Well, guess what? This tool will now rank all of the stocks in our bullish counter trend list with the optimal long call option to buy and rank it for you where the best call options are at the top of the list. So now maybe you think, okay, Las Vegas Sands could really bounce. Let me look at buying call options on Las Vegas Sands. The whole point is that no matter what strategy you trade, this tool will find you the right stocks to buy, buy or sell options on, and then identify which options to buy and sell on, and then rank it for you so that you don't have to look at a list of 50 stocks and figure out which ones you want to trade. You just focus on the ones at the top of the list because those are the ones that have the best outcomes from an options trading perspective. So not only are we finding stocks that have optimal timing from a technical perspective, now we're merging it with the best options trades that you can make for those specific stocks so that you are really trading the best of both worlds, and everything done is done in real time for just $40 a month. I can't tell you enough how much time I have spent using this tool, and I can tell you it vastly exceeds the $40 a month that I pay for this particular service. And yes, I pay for this service. I pay the $40 a month because it is easily worth it in terms of time savings and easily worth it in terms of for me to make sure that I know I'm trading the best opportunities, because there's no way I'm going through 50 options chains manually. I have no idea when I have 50 ideas which stocks are going to give me the highest yield. Now I know for sure which stocks give me the highest yield, and I know I'm maximizing my yield when I utilize this tool, which is why I continue to say $40 a month, I think, represents some of the best value for this particular tool. You're going to get personalized option strategies. You can personalize these strategies to whatever preferences that you have. If you don't want to use the 30-day aggressive short put, you can change it to 21 days or 45 days. You can change it to more conservative strike prices. You can change your risk tolerance, and whatever changes you make, you click on that update button, everything is redone for you in under 2 seconds. That's how fast our algorithms work. It's incredibly important that you utilize this tool to make sure that you're maximizing your opportunities. And on top of that, we do members only events every single month where we do in-depth education on how to utilize the tool and how to utilize the tool and specific option strategies. So I have another event coming up in 2 weeks' time on April 15th at 12 p.m., the same time that we are hosting this session. So exactly 2 weeks from today, on how to supercharge your income in volatile markets. Volatility is high right now. How can you harness that volatility and collect income? Not just from selling short puts, not just from selling cover calls, but other strategies like credit spreads and iron condors. We'll be covering that here on April 15th. That is a members only event. So you have to have an OptionsPlay subscription in order to join that event. And that has been a very widely attended event in the last few months as we started to roll out those members only events every single month. We host them on the third Tuesday of every month at 12 p.m. Eastern. And it's a fantastic event where you get to ask a lot of questions because it's only members that are attending in that session. And you can ask a lot of questions at the end specifically to the strategy that we're going to cover during that session. Last time we covered short puts. The previous one we covered cover calls. And this time we're going to be covering all of the rest of the strategies that you can use in a volatile market to collect income. But overall, I cannot stress enough how much this tool, we built for ourselves. We truly built this tool because we as traders struggled with finding, stocks to sell, stocks to buy, and then trying to find the right option strategy to trade. Because, a lot of times you run a scan, you get 50 names out of it. how do you prioritize which ones you're going to look, pull up the options chains for? It's really just a shot in the dark, right? You kind of say, okay, I know that stock. I know it's pretty liquid, so let me pull up the options chain. Sometimes you don't know the stock. You pull up the options chain, you do all this research, and then you find out there's not a lot of liquidity in it, so that you kind of wasted all this time. I cannot tell you enough how much time I have wasted searching for ideas. And we built this tool because we just were sick of wasting time. And we built this tool to make our lives easier. And now we're really excited that we have this partnership with StockCharts.com that maximizes the technical screening capabilities of StockCharts.com with the option screening capabilities of OptionsPlay, and produced a combined tool at a very cost-effective price point, in my opinion, and it provides you all of this, the best of both worlds in real time that's fully personalized to you for just $40 a month. And I cannot stress enough how much, if you were to use the Bullish Countertrend short put scan, how you should be able to find plenty of opportunities in the top few opportunities that should be able to generate. Here, look at Moderna, $1.65, CRISPR, $1.95, Caesars Entertainment, $1.35, Block 275. That's going to cover a minimum of 4, if not 6 months of your service from just your first trade. And that's how much income you should expect to collect from these types of strategies. And we are showing you the strategies that collect the most yield in the markets here right now. And that's how you're maximizing your income and you're getting your money's worth when you're spending that $40 a month. So you can, again, sign up using that QR code here on your screen, or you can go to StockCharts.com, the website, and add on the OptionsPlay platform. When you click on the strategy center, if you don't have access to it, you will see the links on how to subscribe and how to add your add-on by going to the strategy center itself. If you don't currently have a subscription, going to that link will prompt you for adding your subscription. With that, I hope that this is helpful for everyone. Please let me know if you have any questions. There's a Q&A section here. If you have any questions, type your questions in the Q&A window. I'll spend a few minutes answering some of your questions before I sign off for today. Linda's asking, is the premium immediately credited to your trading account or deducted when the short put expires and called away? No, the premium is credited to your account immediately. Now, here's the thing, is that that's an unrealized gain, right? Meaning you have to once the short put expires, then it turns into a realized gain, but the money is credited to your account immediately. What happens when the stock price goes down 3 to 5% below your strike price? If it goes to 3 to 5% below your strike price and you've gotten a 4.5% discount, then you're basically flat on the trade, right? That's kind of the cushion that you're getting. Like if you bought a stock and it went down 3 to 5%, you're down 3 to 5%. If you sold a short put and went down 3.5%, 5%, and you collected 5% on the short put, then you're flat on the trade. So that's part of why, if you have the opportunity to sell a put, you always should sell the put because it gives you that downside buffer. Why not take that downside buffer? Why pass it up? A lot of people pass it up because they don't know the strategy. They don't know how to implement it. Here, hopefully after this session, you really have no excuse to, one, not know about the strategy or not know how to implement it because everything is automated for you. If the stock goes down quickly, then closing the option is the way to prevent owning the stock. What is the potential loss? Well, I mean, you'll see the unrealized losses, on your platform, right? Just like how if you buy a stock and the stock goes down, you'll see the unrealized loss on your platform. You'll see the unrealized loss on your platform as well. But I will tell you, it's going to be less downside than if you bought the stock and the stock went down quickly, because you're always going to have the cushion from the income to offset the losses that you have on the stock. Out of that list, how do you get the cheaper put options? You just sort it by stock price. That's going to give you the cheapest put options to sell. I always play options with the most liquid stocks. In short put options list, how do I know the most liquid stocks? So with each of these, so number one, we only show you very liquid and somewhat liquid. We completely remove anything that's not liquid, right? So right off the bat, if something's on this list, you should be able to execute this trade. Now, but within each one, as you can see, when I go to EWW, I have a liquidity rank, right? So within each idea, I have a liquidity rank. Let me see if I can find you one that's maybe somewhat liquid. Nope, these are all pretty liquid. Let's see, maybe Vertex. Okay, Vertex Pharmaceuticals, as you can see, liquidity rank 2, somewhat liquid. That's the worst liquidity that you're going to get. You're not going to get anything that has that's not liquid. So we've already removed anything that's not liquid from this list. So that's another thing that's saving you time. I can't tell you enough how many times people have ran a technical scan, liked it, looked at the chart, looked at the fundamentals, really liked it, went to the options chain, and then realized that the options weren't liquid. So you did all this work on the underlying, went to go look at options, and then realized you can't trade options on it. We have designed this so that you never find yourself in that position again. Because if something's on the list, it's at least somewhat liquid, and you should be able to place a trade, using a limit order. Does this tool cover Canadian stocks? Not at the moment, but that is something that we are looking into if there's demand for that. So if you want this for Canadian stocks, please let the StockCharts team know in terms of your feedback, and we can use that as the information that we need to build out our roadmap. I can tell you that we've already started to build out this in our version 2. I already have seen the development for it, where you can then not only look at all of these strategies on the trading ideas that we have for the day, but you'll be able to do it on your own chart list. So very, very soon you'll be able, you all have chart lists at stockcharts.com. You'll soon be able to run all of these option strategies on the stocks in your chart list. So that you can basically say, okay, out of the stocks on my chart list, which ones have the highest yield if I were to sell puts? What are the cheapest call options to buy? What are the best iron condors to sell? All of these different strategies are covered here. Today, we're just covered short puts. We're just kind of showing you the tip of the iceberg here. So again, just on that one strategy alone, you're getting a ton of value, not to even mention, the value that you can get from all of the other strategies that I didn't even cover during today's session. So we really tried to make this price point a no-brainer and a price point that is, within reach for almost every investor, no matter how small of an account that you have. If the stock goes up fast, then you missed opportunity. In that case, selling put is not a good idea. If you sold the put and the stock moves substantially higher, that's what I call a high class problem. I stole that term from Tom Sosnoff, but I really like that term because, to say that I earned 4.5% in a month and I'm really pissed off at that is kind of again a high class problem to earn 4.5% in a month and be upset about that. If you lost 4.5% in a month, I'd say you have that's a good point that you missed that, it's not a good idea, but earning 4.5% and saying that's not a good idea is I don't think of that as a bad problem to have. Does it matter what trading platform? Nope. Almost every single trading platform will allow you to sell a cash secured put as long as you have an options account. If the underlying drops precipitously, i.e. worst case scenario, how do you exit the trade? You buy back the put up. So you sold the put, you have to buy it back to exit, right? So if you buy something, you got to sell it to exit. If you sell something, you got to buy it back to exit. So you're just doing the reverse. I saw quite a few questions saying, can this tool be applied to existing chart lists? And the answer, as StockCharts support has answered correctly, is currently no. But we've already developed the tool to merge into your chart list. We're just waiting for it to be released into production. So it's not saying, we're not even saying it's in the roadmap. It's already been done from a development perspective. We're just still testing it before we release it in version 2. But version 2 is coming very soon. And I'm really excited about that because, I've been looking forward to running these scans on my own chart list for a while. And I'm really happy that that's going to be included in the very next version of the OptionsPlay add-on. So if you add your account here, if you add your OptionsPlay subscription here, you will be able to access this very soon for your own chart list as well. If there are no other questions, I just want to thank everyone for taking the time out here this afternoon. I really hope that this is helpful in giving you a better understanding of this particular strategy, and more importantly, the tools that you have available at StockCharts.com to help you maximize income and help you navigate the current volatility that we see here in the broader markets. Because this volatility has driven implied volatilities on options quite high, and you're going to generate a lot of yield. Not to mention, there are a lot of bounce opportunities out there right now, given how far the markets have sold off. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here, hopefully on the member session here in 2 weeks' time. If you start your OptionsPlay subscription, you'll be able to join me in 2 weeks' time on that session on how to generate income in volatile markets. Thank you so much and have a great trading day.